Welcome to episode 8 of PolicyCast. In today's episode, we are highlighting some key changes in taxation provisions that taxpayers need to take note of, as these are applicable for financial year 2024-25. We have Riaz with us today. He will help us understand these in detail. Welcome, Riaz. My first question to you is, with the shift in taxability of buyback proceeds from company level tax to shareholder level dividend taxation, what is it that taxpayers must take note of?
Yeah, thanks. As you've rightly pointed out, from 1st October 24, buyback tax amount applicable on domestic companies has been done away with. Hence, the buyback amount is taxable now in the hands of the shareholders, and there are no tax implications on the domestic companies undertaking the buyback of shares. Earlier, the domestic company was subject to tax at the rate of 20% plus applicable cess and surcharge. So, a few important points that are relevant for this year and need to be kept in mind are: one, the amount received on buyback of shares is to be treated as dividend income, and no deduction of expenses may be claimed by the shareholder. Of course, the shareholders will be entitled to claim the original cost of acquisition of shares as capital loss, which may be adjusted against the capital gains in the subsequent years. Secondly, in case the taxpayer is claiming treaty benefits, analysis of the exact tax impact and classification with reference to language of the relevant tax treaty is required. And finally, the transaction of buyback prior to 1st October 24 is required to be reported separately under the buyback schedule in the ITR and analyzed in detail for transactions that are still part spillover.
Thank you, Riaz. That's a helpful clarification. Moving to another major change this year, the capital gains regime has been overhauled with new rates and holding periods. How does this affect reporting and return filing?
The Finance Act number 2, 2024 had rationalized the capital gains tax regime with effect from 23rd July 24. So the taxpayers need to pay special attention to this cutoff date. One should also pay special attention to proper categorization of the capital assets, keeping in mind the change in the classification of long-term and short-term capital assets. In a nutshell, things to remember are: one, all listed securities, units of equity-oriented mutual funds, and units of business trusts qualify as long-term capital assets if the period of holding is 12 months or more. For other assets, the holding period is 24 months to qualify as a long-term capital asset. Thirdly, the exemption threshold for long-term capital gains on equity shares, units of equity-oriented funds, and business trusts on which securities transaction tax is paid has increased to 1.25 lakhs from 1 lakh. Fourthly, with effect from 23rd July 24, a long-term capital gains are now taxable at 12.5%. Prior to 23rd July 24, the tax rate is 10% without indexation and 20% with indexation. Short-term capital gains on STD paid equity shares, units of equity mutual funds, and units of business trusts are taxable at 20%. Prior to 23rd July 24, the rate of tax is 15%. Other short-term capital gains are taxable at the applicable tax rates. Further, in the case of non-residents of foreign companies, if transfer takes place on or after 23rd July 24, capital gains is taxable at 12.55%, which is to be computed without indexation or foreign currency conversion benefit. The capital gains schedule in the income tax return has been modified to report capital gains on transactions where transfer has taken place prior to 23rd July 24 and post 23rd July 24. So these are some of the key things to remember.
Thank you. That clears up the implications quite well. What about the changes related to equalization levy which become applicable for this return filing period?
So the Finance Act number 2, of 2024 abolished the 2% equalization levy on the consideration earned by non-resident e-commerce operators for e-commerce supply or services with effect from 1st August 24. The equalization levy provisions were deleted to address the stakeholders' concerns regarding its scope, which resulted in ambiguity, and also to reduce the compliance burden. With the removal of equalization levy 2.0, payment made towards online purchase of goods and services from foreign service providers may get covered under the Indian domestic law. So classification of income as royalty or fees for technical services or business income becomes relevant depending upon the circumstances of the case. The equalization levy of 6% on specified services like online advertising has also been withdrawn from 1st April 25, which would impact the next financial year, that is 25-26.
Thank you, that's quite insightful. Now shifting gears a bit, a new presumptive scheme has been introduced for non-resident cruise ship operators. How does this affect the computation of income and reporting?
So the Finance Act 2024 also introduced a presumptive taxation regime for non-resident cruise ship operators in India. As per these provisions, 20% of the total income received for carrying passengers will be taxed as profits and gains subject to prescribed conditions. The CBDT issued a notification prescribing the conditions which are required to be fulfilled by such non-residents, like the passenger carrying capacity of a ship, having the appropriate dining and cabin facilities for passengers, operations of cruise ships primarily for carrying passengers and not cargo, and the guidelines issued by the Ministry of Tourism, Ministry of Shipping, etc. to be fulfilled. These conditions are required to be taken care of while filing tax returns or for all the taxpayers opting for presumptive taxation scheme for non-resident cruise ship operators. So it's important to analyze the eligibility conditions in detail before making any claim. Further, lease rentals received by foreign companies leasing cruise ships to such non-resident cruise ship operators would also be tax exempt if the non-resident opts for the scheme. I hope that clarifies the new presumptive scheme.
It does, and that's an interesting development. Before we wrap up, my last question is on the recent key jurisprudence, which may also be taken into consideration while filing a corporate tax return for the companies. Request you to highlight the important ones for our listeners.
Yes, there are a few Supreme Court and High Court decisions which will have an impact while filing tax returns for corporates. In the case of Johnson Matthey Public Limited Company, the Supreme Court held that guarantee charges received from Indian subsidiaries was taxable as other income as per the India-UK tax treaty and not as business income. This has a considerable impact. The second decision is in the case of Vodafone Idea Limited, where it was held that payments from bandwidth and interconnectivity usage would not be taxable as royalty and would be taxable as business income. Again, a significant impact. The third decision is the case of Jupiter Capital Private Limited. Here, the Supreme Court held that capital reduction would be regarded as a transfer as it is covered within the ambit of the expression sale, exchange or relinquishment. Accordingly, in such situations, the benefit of long-term capital loss may be claimed by the taxpayer on account of capital reduction. This is of particular importance to all M&A transactions. In the decision of Telangana High Court in Ayodhya Rami Reddy, the High Court held that both GAR and SAR provisions could be applied depending on the facts of each case. This High Court judgment reflects a developing judicial view on the interplay of GAR and SAR, though tax provisions indicate that both can coexist. So there are a number of judicial pronouncements which have had an impact in the recent past on the tax computations, and the taxpayers should be mindful of these.
With this, we come to the end of this episode of PolicyCast. A big thank you to you, Riaz, for highlighting some of the key changes that become relevant this year, and hence taxpayers may need to evaluate the positions they take. I'm sure our listeners find them insightful. Stay tuned for more conversations on tax and regulatory developments. Until next time, thanks for listening.
Thank you.